Hi, this is Bill Paulus from Profits Run. What if I told you that there's a little known way to create automatic, instant income every time you place a special kind of trade, where the realistic goal is to earn up to 2% of your total account size every 7 days. Now that's the equivalent of up to 8% every month or up to 104% every year, with less risk than just about any other kind of trading, no matter what happens in the markets. And no, it's not Forex, it's not stocks, and it's not ETFs. It also doesn't involve day trading, and it doesn't require that you stare at the charts all day to find trades. So what is it? It's an unusual way to trade weekly options, completely unlike how most people have traded options traditionally. And if the thought of options trading makes you nervous, or if you think it's complicated and confusing, you don't have to worry. Even if you don't know how options trading works, you don't have to worry. That's because I've discovered a way to trade weekly options that almost anybody can understand and implement almost immediately, with very little training and also with a relatively modest account size, especially compared to traditional options trading requirements. And maybe the best part is that it just takes a few minutes every Thursday or Friday, once a week. As soon as you place a trade, money is deposited into your account 100% of the time. Now that's the magic of weekly options, as you're about to see. This technique also gives you a lot of flexibility because it can work with IRAs in addition to regular brokerage accounts. Even if your IRA broker has told you in the past that you can't trade options, they may have been lying to you because they don't like the hassle of the extra paperwork required. But we'll show you exactly how to get around this so that you can easily use this technique to have the potential to create weekly instant income in your IRA. And as you'll soon see, this could quite possibly be the safest and most lucrative way to leverage your IRA as well as your traditional brokerage accounts. So in this 3-part video training series, I'm going to teach you my simple step-by-step rules that you can use 52 times a year to create what I call instant options income again and again. And while the information you're about to learn is very easy to understand, it's important that you actively watch these training videos and take notes. So find a quiet place, close the door, turn off your phone, shut down your email, and watch these videos with an active mind. By the time you're done with just this first video, I think you're going to be very excited by this approach, and you'll probably want to start using it right away. So are you ready to begin? Okay, let's get started. First of all, why even consider weekly options? What's wrong with just directly buying and selling stocks, or Forex, or ETFs? Well, nothing's wrong with that as long as the trade moves in your favor. Think of it like this. Every time you place a trade, one of 3 things can happen. The market can go up, it can go down, or the market can remain flat or sideways. So if you buy a stock, for example, the price of that stock must go up in order for you to make money. If it drops, you lose money. And if it remains flat, you break even. So there are 2 market conditions that prevent you from making money this way. This is how most people trade. And as you know, most people lose money in the markets. However, when you use weekly options the way I'm going to teach you, you not only make money when the price of the stock goes up, but you also make the same amount of money if the price remains the same or goes sideways. Further, you dramatically limit your losses if the price of the stock drops. So of the 3 things that can happen to the price of a stock, up, down, or sideways, you make money on 2 of them instead of just 1 like regular traders do. It'll all make perfect sense by the time you're done watching this video. But first, let me show you some actual trade examples using my instant options income technique so you can see the tremendous amount of profit potential that's available. Each of these trades uses my credit spread strategy that you're going to learn a little later in this video. Don't worry about the actual strategy being used right now. Just focus on the huge amount of profit potential that can be generated on a weekly basis. We'll revisit more trades like this in more detail in one of the future videos. Okay, here's a chart of Apple, AAPL. Trade was placed after the close of 5/16 when the market opened right in here. To sell to open a 425 put, that's at this price level here, and to buy to open a 415 put, that's at this price level right here. And so as long as the market closes 7 days later at or above around 423, this trade makes money. And in this case, the options expired worthless, which is exactly what you want them to do when using this strategy. And I'll cover that in detail later in this video, but right now just know that $2,150 of instant income was created in just 7 days, or a 27.4% return on investment. Next is USO, trade placed before the open on Friday, right in here. And that was to sell to open a 33 put, which is at this price level right here, to buy to open a 32 put right in here. And as long as the market closes at or above, just below that 33 level, this trade makes money. And you can see the market did drop, but it did not close below 33, yielding $130 instant income or 14.9% ROI in 7 days. Next is INTC Intel, trade placed before the open on Friday, where it opened right around in here, to sell to open a 23.50 put. That's this price level right in here. And to buy to open a 23 put right in here. So as long as the market closes at or above, just below this 23.50 level, this trade's going to make money. And indeed, you can see the market kind of chopped sideways and moved on down, but it did not close below 23.50. So options expired worthless. Again, that's what we want to have happen, yielding an $80 instant income or 19% ROI. Here's a chart of Caterpillar, CAT. Trade placed before the open on Friday, 5/17, where the open was right in here, to sell to open an 85 put. That's at this price level. And an 82.50 put to buy right in here. And again, as long as the market doesn't close below 85, this trade's going to make money. And you can see it really didn't go anywhere. It went up a little, then down, but it did close above 85. Options expire worthless, $360 of instant income, 16.8% ROI. And here's a chart of FCX trade placed before the market opened Friday, 5/17, where it did open right in here, to sell to open a 31 put. That's at this level here. And buy to open a 30 put. And you can see this market, after moving up, then turned on down and traded on down. Now, not every trade can be a winner, but with this strategy, the odds are definitely strongly in your favor. And even in this case where the trade didn't work out, the result was a $40 loss or a minus 4.87% ROI. Here's a chart of IBM, trade placed before the Friday open, where the market opened right in here, to sell to open a 200 put. That's at this price level right here. Buy to open a 195, which is right in here. And you can see the market did move up a little bit, chop sideways, probably closed around break even, but well above 200, where the options then expired worthless as we would like them to, yielding a $600 instant income or 13.7% ROI in just 7 days. I think you'll agree that those are some awesome trades. And because you have the opportunity to generate income like that 52 times a year, weekly options offer significantly more income potential than many other kinds of trading. It's just an amazing way to trade, and I can't wait for you to experience it. Now, if you remember from earlier, I said the goal of my instant options income technique is to earn up to 2% of your total account size every week. Now, let's put that into perspective based on the size of your trading account. So if you have a $100,000 trading account, you can expect to earn up to $2,000 per week. Now that's the equivalent of $8,000 per month or $104,000 per year using this approach. Now remember, this is the goal. It's not guaranteed income, but more often than not, you can expect to do very, very well. And you can see the potential for other account sizes on this chart. So even with a $5,000 account, you have the potential to bring in an extra $400 a month. Of course, if you put your potential earnings back into your account, the numbers can get even bigger. So as you can see, my instant options income technique is ideal for both small and large accounts. So here's how weekly options work. In 2005, the Chicago Board of Options Exchange, the CBOE, introduced weekly options. They work the same as monthly options, except they only exist for 8 days. Every week on Thursday, new weekly options are created for over 160 U.S. stocks, which expire 8 days later on Friday. Now that happens 52 times a year. And because money is instantly deposited in your account every time you place a trade with my instant options income technique, it really does kind of make Friday feel like an extra payday. So your trading plan could look as simple as this calendar, leaving the rest of the week open to do whatever you want. Now you don't have the stress of day trading where you need to watch your positions throughout the day. You don't have to monitor your positions with end-of-day trading to adjust any stop orders. You basically spend a few minutes after the markets close Thursday or before they open on Friday and enter your orders. That's it. You literally can just set it and forget it. That gives you the rest of the week to do whatever you want. It really is that simple. And ever since their introduction, weekly options have continued to grow in popularity, as you can see in this graph, which shows the average daily weekly options volume per month according to the CBOE. As of the recording of this video, nearly 800,000 weekly option contracts are traded every day. That's a lot of volume, which is what we like as traders, so you're guaranteed to get your trades filled using the techniques I'm about to show you. Okay, here we go. There are several parts to creating instant options income, which you'll learn in these training videos. The first part is the credit spread strategy. Let's take a look at how it works. Now, the credit spread strategy is nothing new. However, you need to use it with very precise, low-risk points in the market in order to create a high-probability approach to generating consistent income week after week. And that's exactly what I'm going to show you how to do. Now, I've spent thousands of dollars and thousands of hours studying options trading over the past 4 decades. And from everything I've tried and tested, my instant options income technique is the safest way to generate income with fixed limited risk and a minimal margin requirement. It all starts with the credit spread strategy. So let me show you how to use it step by step. Now, in order to understand how this strategy works, you need to be familiar with some very basic options trading concepts. First, a put option. A put option is a contract between two parties to exchange a stock at a strike price by a predetermined date. One party, the buyer of the put, has the right, but not an obligation, to sell the stock at the strike price by the future date, while the other party, the seller of the put, has the obligation to buy the stock from the buyer of the put at the strike price if the buyer exercises the option. For example, if a stock is trading at $50 and you think it's going to go down to $40, you might buy a $45 put option for, say, 20 cents. If the stock did drop to $40, that would allow you to sell the stock at $45 even though it's valued at $40, netting you a $4.80 profit on each share. On the other hand, the person that sold you the put would be obligated to buy the stock from you at $45 at a loss of $4.80. If the stock never drops below $45 by expiration date, the put expires worthless, and the put buyer is out 20 cents, and the put seller keeps the 20 cents. Next is the call option. Now, the call option is a contract between two parties to exchange a stock at a strike price by a predetermined date. One party, the buyer of the call, has the right, but not an obligation, to buy the stock at the strike price by the future date, while the other party, the seller of the call, has the obligation to sell the stock to the buyer at the strike price if the buyer exercises the option. For example, if a stock is trading at $50 and you think it's going to go up to $60, you might buy a $55 call option for, say, 20 cents. If the stock rose to $60, that would allow you to buy the stock at $55 even though it's valued at $60, netting you a $4.80 profit on each share. On the other hand, the person that sold you the call would be obligated to sell you the stock at $55 at a loss of $4.80. Now, if the stock never rises above $55 by expiration date, well, then the call expires worthless and the call buyer is out 20 cents and the call seller keeps the 20 cents. That's a very simple explanation of puts and calls, but that's really all you need to know about options in order to understand the credit spread strategy. So to make this really easy to understand, I'm going to use an analogy. And then I'm going to apply the concepts from that analogy to an actual stock chart so you can see how it works. Now, as I go through this analogy, I want you to think of yourself as Isaac, the insurer. Okay, let's say Henry, the homeowner, owns a house currently valued at $300,000. He wants to sell it, but he can't move for 7 days. And furthermore, he's worried the housing market could crash in the next 7 days and the value of his home could plummet to $250,000. So to protect himself, he buys an insurance contract from Isaac, the insurer, in the form of a $290,000 put, which costs him $4,700. Now, this gives Henry the right to sell his home in the next 7 days to Isaac for $290,000. And Isaac is now legally obligated to purchase Henry's home for that amount. Isaac gets to keep the $4,700 as instant income in return for his obligation. While Henry doesn't want the value of his home to drop below $290,000 in the next 7 days, if it does, he won't lose nearly as much had he not purchased the put from Isaac. Isaac was willing to sell the insurance, or the put, to Henry because he thinks that the housing market will remain stable or even go up in the next 7 days. If Isaac is right and the value of the home stays the same and is still worth $300,000 or even drops down to $290,001 in the next 7 days, Henry will not want to sell it below the market for $290,000. But Isaac still gets to keep the $4,700, making a profit. However, if Henry's concern holds true and his home's value drops to $250,000, he can sell his house to Isaac for $290,000 and end up netting $290,000 minus the cost of the option he purchased for $4,700, or $285,300. In this case, Isaac might choose to sell the house for $250,000, limiting his loss to $35,300. But a $35,300 loss is a lot of risk to just make a profit of $4,700. In other words, Isaac had to have $35,300 set aside in order to sell Henry that put option in the event that Isaac had to fulfill his obligation to buy the home for $290,000. That makes Isaac's maximum return on investment, in this case, $4,700 divided by $35,300, or 13.3%. Now, 13% is not a bad ROI, but using the credit spread strategy that you're going to learn, Isaac can increase his ROI potential by more than 5 times while also dramatically limiting his risk. So let's go back to the beginning and see how this works. So once again, Henry buys a $290,000 put from Isaac for $4,700. This gives Henry the right to sell his home in the next 7 days to Isaac for $290,000, and Isaac is now legally obligated to purchase Henry's home for that amount. Isaac gets to keep the $4,700 as instant income in return for his obligation. Now, Isaac is a smart investor, and in order to protect himself, he contacts Gary the gambler and buys a $280,000 put for $1,300. This gives Isaac the right to sell the house to Gary for $280,000, and Gary is now legally obligated to purchase the home for that amount. Now, Gary's gambling that the price of the house will not fall below $280,000 in the next 7 days. The likelihood of the price falling that much is very low, but if it does, he must suffer the consequences. Isaac still wants the housing market to remain stable, go down a little or go up. So let's see what happens now. If the home value drops to $250,000, Isaac honors his original obligation to Henry and buys the house for $290,000. But then he immediately sells it to Gary for $280,000. So Isaac ends up losing $10,000, flipping the house from Henry to Gary. That's $290,000 minus $280,000. But he also still has the $4,700 he collected from the put that he sold Henry, minus the $1,300 for the put that he bought from Gary, which gives Isaac a net loss of only $6,600, compared to the prior net loss of $35,300 he would have suffered had he not bought a $280,000 put from Gary. Isaac has reduced his risk by more than 5 times using this strategy. Furthermore, if you remember, Isaac's maximum return on investment in the prior example was $4,700 divided by $35,300, or a 13.3% maximum return. And in this example, it's $3,400 divided by only $6,600, or a 51.5% return on investment. That means that Isaac only had to have $6,600 in his account in order to use the credit spread strategy to his advantage. Gary's the one who loses the most money in this scenario because after purchasing the home from Isaac for $280,000, if he sold at the market for $250,000, he would have had a net loss of $28,700. And if the home's value stayed at $300,000, Henry would have sold it at market price to someone else, netting $295,300. Since Isaac didn't need to fulfill his obligation to buy the house for $290,000, he keeps the $4,700 he got from Henry, minus the $1,300 he gave to Gary, for a net profit of $3,400, or a 51.5% return on his investment. And Gary also made a small profit of $1,300 because he didn't have to fulfill his obligation to buy the house for $280,000 because Isaac never owned it. So in this example, Isaac is the smart investor because he dramatically limited his risk and maximized his return on investment by using the credit spread strategy. Now, I'm going to show you how you can play the part of Isaac and use the same strategy 52 times a year with weekly options. So this technique will work in both uptrending or bull markets and also in downtrending or bear markets. In an uptrending market, you'll use what's called a bull credit spread, and in a downtrending market, you'll use a bear credit spread. For the example in this video, we're going to use a bull credit spread, but just remember that the opposite of what you're about to learn works just as well and sometimes even better in a downtrending market because bear markets tend to drop more quickly than bull markets tend to rise. So let's take a quick look here now at how to apply a bull credit spread. Okay, here's a chart of AXP, American Express. How we chose this particular market is the topic of the next training video because stock selection is a critical component of making the instant options income technique work. You can't just blindly apply credit spreads to any market. But for right now, we're going to focus on the actual credit spread strategy. Okay, so after Thursday's close and prior to Friday's open, we're going to enter an order to sell the 1 strike out of the money and buy the 2 strike out of the money weekly options as follows. Sell to open 10 contracts of the April week 4 62.50 put at a 27-cent credit. Now, if this type of order doesn't make sense to you, don't worry. All it means is that you're selling a put option to someone else that wants to buy insurance, that wants to buy a put option. And it means that you have the obligation to sell that person that bought the put, AXP, American Express, at $62.50 for the next 7 days. And at the same time, you're going to place an order to buy to open 10 contracts of the April week 4 60 put at a 4-cent debit for a net credit of 23 cents with the limit order. Again, if you're unfamiliar with this type of order, all it means is that you're buying insurance against your position in the event the stock dropped below $60, which means you would have the right to sell AXP to someone else for $60. Now, when you place a credit spread trade, you're placing both legs of the trade, the sell to open and the buy to open, at the same time for a net credit of the price that you stipulate. Now, when this order is filled, $230 is deposited into your account, literally creating instant options income. This is a credit that you get for selling the weekly option. Now, depending on what happens over the next 8 days will determine how much of the $230 you get to keep. So let's look at the outcomes. First, the AXP stock closes higher on Friday of the following week on April 26th. If this happens, both options expire worthless and you get to keep the credit of $230. Action required, none. This is exactly what you want to have happen. Because the options expire worthless, you have no obligation to buy or sell AXP, so you get to keep your entire instant options income credit of $590. Outcome number 2, the AXP stock closes sideways to down on the Friday of the following week as low as $62.50, a drop of 4.3% in 1 week. If this happens, both options still expire worthless and you still get to keep the credit of $230. Action required, none. Again, this is another desired outcome and it illustrates the power that this strategy gives you. If you had just purchased the AXP stock directly and the market dropped 4.3% after 7 days, your position would be down 4.3% if you didn't have a stop order in place to limit your loss. But when you use the credit spread strategy, you have a lot more leeway in how far the market can drop before you take a loss. This factor alone removes a lot of the stress normally associated with the regular trading that most people do. The third outcome, the AXP stock closes down on Friday of the following week to $62.27. That's a drop of 4.7% in 1 week. And even if that happens, you break even on the spread and the $60 put expires worthless. Action required. Buy at close the $62.50 put. Now that's because that put is in the money and has a value of 23 cents, equal to the credit you received when you put the spread on. So you need to close that out at 23-cent debit, which offsets your credit, breaking you even on the trade. The fourth possible outcome, the AXP stock closes down on Friday the following week to $60 or lower, a drop of 8.2% or more. You lose $2,500, the difference in the strikes, less the credit of $230 for a net loss of $2,270. Action required. Buy to close the $62.50 put and sell to close the $60 put, and that will get you out of the spread at a loss of $2,270. Now, the likelihood of that happening again is that the stock would have to drop 8.2% in 1 week. Not very likely, but it could happen, and so you want to limit your risk. Now, if the stock dropped dramatically for some unknown reason, well below 60, Your loss would be limited to $2,270. However, this outcome is even more unlikely because of a little-known conservative strategy that practically eliminates this already highly unlikely outcome. And here's how it works. All right, let's say the AXP stock closes below $62.50 prior to Friday of the following week to $62 on Tuesday, for example. Now, that's still a drop of 5.1% in a matter of 2 or 3 days. Very, very unlikely, but it could happen. Now, in such a case, the spread would be trading around 50 cents at that point. What you would do is close out the spread on the open of the next day. That would be prior to the Friday expiration. In this example, that would be Wednesday. And you would do that at a loss of $500. That's the difference between the strike price of $62.50 and the $62 close, less the credit you received of $230 for a net loss of $270. So I hope you can see that this strategy practically eliminates the already highly unlikely maximum loss that we discussed on the prior slide. So in this example, even if the stock drops 5.1% in a matter of a few days, and remember, we're selecting the right stock at the right time where market conditions are such that it is extremely unlikely that this would occur. But if it did, you're out with a $270 loss. Action required, you just simply buy to close the $62.50 put and sell to close the $60 put. So in this example, in order to lose money with this strategy, the underlying stock would have to fall at least more than 4.7% in only 1 week, with the maximum possible loss occurring if the stock dropped by a whopping 8.2% or more in 1 week. So with a credit spread strategy, we're betting that most of the time, a properly selected stock will not drop 4.7% in only 1 week, and certainly wouldn't drop 8.2% in 1 week. So that in our example here, if the stock goes up, goes sideways, or even goes down a little, you still get to keep the income by selling that credit spread. So by now, I hope you're beginning to see why I'm so excited about this technique. There's just so much going in your favor when you place these trades, especially compared to regular trading. And if you're new to options, you might be a little confused or unclear about some of what I just taught you. If that's the case, don't worry. Go back and watch this video again and let it soak in. By the time you've seen all 3 of my training videos, everything will make a lot more sense. Plus, you're going to see how you can essentially copy and paste my very best weekly options trades later on, which will remove any lingering questions or concerns you might have. Now, weekly options aren't difficult to understand, and they're very easy to trade. I think the main reason most people don't trade them because they're not willing to take the time required to learn some new ways to potentially make a lot of extra money. So now that you've seen the first part of my instant options income technique, let me quickly introduce myself in case you're unfamiliar with me and my background. As I mentioned earlier, my name is Bill Paulus, and I've been trading the market since 1974. It's my passion. It's what I love to do. I think I was attracted to trading in the first place because of my background as an industrial engineer, which is the field of study I got my first degree in. I learned how to create, test, and perfect systems. For many years, this is what I did in my automotive career. That was my day job. But my night job was trading the markets. After I got my MBA from the University of Michigan, I thought it might be fun to start a business one day to teach people what I knew about trading. Well, that dream finally came true for me in 2001 when I started my financial education company, Profits Run, with my son Greg. We literally started it from the kitchen table, and now, over 10 years later, we have a modest office and over a dozen full-time employees that have helped us train nearly 40,000 regular people from all around the world on how to become better, smarter, and more effective traders. From the beginning, my goal was to simplify trading so that almost anyone could have a real shot at potentially creating some extra income in the markets. And I think my teaching hits home with a lot of people since so many of them keep coming back to us for more and more training. So I'm glad to have you here with me in these training videos, and I hope you pick up some useful techniques. Okay, I'm almost done with this first video, but I just want to address a common concern I hear about options trading, and that is, I heard options trading was risky. Well, it is risky if you don't know what you're doing. And you shouldn't be surprised to learn that most people that attempt to trade options really don't know what they're doing, especially when it comes to risk. If you recall from my example earlier in this video, before Isaac knew what he was doing, he had $35,300 at risk. But after he applied the credit spread strategy that you learned in this video, he only had $6,600 at risk with nearly the same profit potential. So while there's always risk with options trading, when you use my instant options income technique, you'll be using options in the least risky way to take advantage of the huge profit potential weekly options have to offer. Plus, there's one more fact that pretty much makes this whole technique something you must get in on. If you remember from earlier, every time we use the credit spread strategy, we want the options to expire worthless. When that happens, we get to keep 100% of the instant income we received when we put the credit spread on. Well, according to data from the Chicago Mercantile Exchange, 80% of options expire worthless. Now, when you combine that fact with excellent timing, you can readily see why the odds are definitely in your favor using this strategy. And that's just another reason to trade weekly options to generate instant options income. So that's it for this video. I hope you enjoyed it and found the idea of creating instant options income 52 times a year appealing. But we're just getting started. As I mentioned before, you can't just blindly apply what you learned in this video to any stock or ETF. You need to pick the ones where the odds of success are heavily in your favor. That's why in the next video, you're going to learn my 5-step options optimizer method that I use to choose the very best stocks and ETFs. Now, you can implement this method in seconds so that you have a short list of the highest probability and lowest risk trading opportunities every week. I'm also going to reveal what I consider to be a fatal flaw in how most people trade options. Once you understand what it is, it'll almost be impossible for you to place a high-risk options trade again. The next video will be posted shortly. In the meantime, make sure you understand everything in this video and go ahead and post a comment below if you like what you've seen so far or if you have any questions. For now, this is Bill Paulus wishing you good trading.